I hope all of you are doing well today. We have on a very special guest, Blake Hooper, founder of Equalizer Exchange, the third largest DEX on the Phantom Network. Blake, thanks for coming on. How are you doing today?
Yeah, fantastic actually. Sunday, so always enjoy a bit of a weekend because it feels like the only time crypto slows down. Definitely doesn't stop. So fantastic to wrap up the weekend with a quick call, getting ready for a big week.
Yeah, for sure.
Thanks for
Um,
having us on.
yeah, for sure. So before we get into it, why don't you tell me a little bit about yourself and the project you're building out?
Yeah, okay, so I suppose just starting off with Equalizer itself, it's a decentralized exchange. Our core mission is to drive volume, revenue to VE equal holders. So just to put it in a nutshell, that is our core mission. Basically, is to find. We look at ourselves as a liquidity hub, and effectively we can house any liquidity. We just need basically fees to support that liquidity, and people will vote it in. So it's a pretty simple model if you just break it down to that level. And effectively, we then use that liquidity for swaps, and there's a fee charged on those swaps, and the participants that lock their equal are able to vote and earn those fees. So that's probably the way we sort of view Equalizer in a nutshell, to try and keep it as simple as possible. And obviously, it's a little bit more complex if you start to go into the inner workings of every angle. Myself, a bit of a business sales slash background there, and a little bit of marketing here and there, so digital marketing, and found basically crypto in 2017 with the Bitcoin sort of rise, where I started to go pretty passionately crazy into researching every aspect of blockchain and trying to get my head around exactly what this interesting digital money or peer-to-peer system was all about, and basically just started knocking down every block to understand all facets of it, and then moving to smart contracts. And with a little bit of software sales experience myself, obviously, I always found that once you have a requirement, you can always just map it out pretty easily in code, right? So the developers are going to kill me for saying that. It's not always easy to map out in code, but effectively, if you have a process and you whiteboard it, then you can generally find out a way to make that tick and work. And smart contracts are very similar to that. So the further I went down that sort of rabbit hole into understanding crypto itself, brought me to the area where we launched Equalizer based on a model that we thought was new and innovative in the space. And for the first time ever, not first time ever, but one of the first times ever, we started to see real yield being generated for people that effectively locked their equal. So that's a little bit about the journey, how we see ourselves, and also how we got to this spot.
Yeah, for sure. Thanks for the answer. So, apart from the real yield narrative that you guys kind of hopped onto, were there any other initial motivations to launch Equalizer? Did you initially have like a problem with some other dexes or some other aspect in DeFi and decide to launch Equalizer as a sort of solution?
Sorry, it was breaking up a little bit there. I didn't hear exactly the whole question.
Yeah, so I said following up on that, you guys obviously hopped on the real yield narrative. But apart from that, were there any other motivations to launch Equalizer? Did you guys initially have a problem with DEX, with some other DEXs or some other aspect of DeFi, and decide to launch Equalizer as a sort of solution?
It is cutting out a fair bit there, but if I'm gathering the question, it's about, did I have other experience with other dexes and understanding other sort of areas of what made this one special. If that's the question, definitely started off with a Uniswap, I think, as everyone does, and a Pancake swap. Then started to learn about the liquidity layer that lands on it. But obviously liquidity on that platform is incentivized by the fees, which is an interesting concept and makes a lot of sense. And people want to obviously take that reward and that's why they provide liquidity for it. But then when we found, or I found, and some of the others on the team found the Solidly model, we obviously thought it made a lot more sense to have a token with utility that governed and basically earned on that platform. If you have a look at your sort of standard model, like a Uni V2, the token holders are not necessarily earning, or basically, sorry, the liquidity providers are earning a token for governance. And I don't think in a lot of cases that's enough. There might be sometimes a small percentage that's paid out to those people, but really there's no incentive for that token to have much utility or value. So when you go to the Solidly model, you have an opportunity for, or what we've used with Equalizer, an opportunity for people to earn on that token, but then govern. And you really start to get utility in the token because it now has value. I see it like its own little ecosystem, and it supports the liquidity, and that liquidity then supports that token. So it's like a big flywheel.
Yeah, for sure. Before we get on to the next question, just want to make sure, can you hear me okay?
Sounding a bit better there.
Yeah, okay. So, Equalizer, if you guys don't know, launched during the bear market. So, Blake, what was the rationale for this? Do you think this will allow you to build a sticky user base? And what I mean by that is essentially a user base that provides liquidity and won't leave or be as mercenary as liquidity on other dexes.
Again, it cut out a little bit, but I think the main thing for launching in a bear, if that's what the question was initially, was that I think it gives you time to build and allows you to come into a space where there's a little bit more time to effectively perfect your craft. And we were very lucky with the point we launched because it was basically the bottom of Bitcoin. Also, research of the market. To me, I did think that was a pretty sort of heavy discounted number. We had a lot of events, Black Swan events, and I was buying Bitcoin at that price too. So I was thinking definitely a nice place to start at the bottom and work in with the next cycle as we believe will occur. So that was definitely the motivation for trying to sort of pick a nice entry level where we were down at lower levels where Bitcoin was sort of hopefully going to start to turn around at some point, and the market in general. And effectively, using that as our catalyst to launch. And as for liquidity, non-mercenary liquidity, I couldn't exactly understand the question there, but I think our model provides an opportunity for liquidity providers to stake some of their tokens and earn from it. I think liquidity by nature can be mercenary, and basically because of the teachings of its earlier sort of where it's come from over these years, that and obviously you have impermanent loss and things like that you want to sort of capture value at a certain point to try and offset some of that stuff. So by nature, liquidity can be mercenary, but we give an opportunity for people to stake that liquidity and earn fees for eternity, effectively. Sorry, to stake the emissions that they receive and earn for as long as they can possibly earn. So.
Thanks for that. So moving on, what do you think is the most important thing for the DEX to succeed? Do you think it's building a liquidity moat or something else?
So the most important thing is obviously to have efficient liquidity. The liquidity, in effect, needs to be able to produce fees that support that liquidity, and it needs to be efficient in that manner so that you can get the most trades out of that. So what I believe is to succeed as a DEX, you need to have a liquidity hub first mentality, because what does a lot of the volume in the market is bots, market activity, your aggregators, arbitrage. So all that sort of stuff is contributing to volume, and you need to have a efficient model and efficient layer of liquidity for those actions to occur on the network, and to select your pools. Based on that, you get the activity, the action, the fees. So basically To succeed, I think you need to have a nice variety of liquidity that's sought after or required, that has nice volatile movement, that a fee can be charged high enough to support that liquidity, and then you need to integrate into a few services and effectively try and use that liquidity to its best potential, and always be looking to improve the efficiency and the integration level of people using that liquidity.
Yeah, for sure. And following up on that, I think Equalizer is set up in a way that allows it to house both both paired assets like stablecoins and LSDs, and also volatile pairs like Bitcoin, USDC, and also you have a fee model that's different from that of other dexes. Do you mind touching on those two things?
Yeah, so I think from our perspective, it's important to have both the stable and volatile pairs because they work hand in hand, right? If you have a good stable pairing, then that stable pairing, because of the low fee and the low slippage, can allow for different routes to be utilized across your decks for people to then use volatile assets. The volatile asset obviously has the larger fee, and in most cases is the most sought after asset that you want to be trading across your decks, simply because the revenue is higher when trades occur. From our perspective, we've worked very, very hard to ensure that we have high levels of liquidity across sought after pairs on the network, blue chip pairs, pairs that people will effectively provide liquidity at lower sort of market rates, as opposed to some of the liquidity that does a lot less volume and needs incentivizing. So we've targeted in very heavily. I think the two work hand in hand, but I also think that there's improved methods that we're going to need to and will be integrating into our decks to ensure that we can continue to supply efficient liquidity to the market for FTM.
Yeah, thanks for that. So, you guys, I think, as we previously mentioned, are DEX on Phantom. So, why did Equalizer launch on the Phantom network? I mean, the way I see it, Phantom succeeding as a layer one would mean that there'd be a significant amount of liquidity on it. Is the hope that that Equalizer would sort of house this liquidity?
Yeah, look, I think Phantom presented a rather unique opportunity because it was, in some ways, a chain that didn't have huge efficient liquidity models and was quickly easy to be adapted to. Also, Phantom has a lot going on the network over the next little period, and if anyone's ever operated on that network, then you'll know pretty quickly that it's a very nice, smooth, low gas sort of network, and that gives you the ability to utilize different methods and to consider different outcomes and different liquidity types over time that would obviously benefit from low gas, low transaction fees, that sort of stuff. But at the same time, you're building on what I believe in some cases, is sort of set the standard for the space. If you have a look at Ethereum, it's just moved to proof of stake. Well, you're looking at FTM or Phantom, which effectively has been running proof of stake for a long time. The gas burning that's been occurring, that deflationary measure, was implemented on Phantom from the beginning. So little things like that you've seen Ethereum move to were already thought of in the space and already conducted on that network. So in some ways, they're a first mover in a lot, and they go a little bit unnoticed. So I think it's a great opportunity for us to sort of, get in there as well and spread the good word about the network and give people an opportunity to experience it. Because a lot of people, once they come there, do fall in love with the network for its simplicity, for its speed, for its transaction costs, things like that. And we know that with Andre at the front there building, the integration of the banking license, things like that, the network's only going to grow, and it's only going to have more and more liquidity housed, and more transactions are going to occur, and obviously swaps, that sort of stuff, are going to come with that.
Yeah. Yeah, there are a lot of exciting things to look forward to on the Phantom network. Also, one thing that I wanted to touch on, I think Phantom is implementing or has implemented already a gas subsidy, wherein a percentage of all fees guzzled by a contract kind of goes back to the deployer. Is this something that Equalizer stands to benefit from? And if it does, do you have any plans, I guess, in this regard?
Yeah, we've already registered our interest with the foundation for that program. They're ironing out a couple of things at the moment in there. It's from some regards, it's a nice little ticker to have, a little extra, but we're not counting on that as the be all and end all. It's just nice to receive a little bit of the gas back, which we can help to fund our operation, to fund infrastructure. When you run a DEX like this, you do effectively have multiple types of costs that come out on a monthly basis just to keep the operation of the DEX from an infrastructure point of view. It goes a nice little way to helping with that. If it can help with a little bit of marketing, but we're not expecting that. There's going to be this huge amount of return coming from that FTM gas incentive, but it's just nice to get a little bit back.
No, I mean, for sure. I mean, I think Phantom is kind of pivoting from incentivizing users to incentivizing builders, and kind of really aligns aligns them for the long term, for sure. And yeah, one more question about I guess Phantom. Is the end goal just to be a liquidity layer on Phantom, or are there any plans for Equalizer to go multi-chain?
Look, for now, and it's funny that we go through this now because we have lots and lots of chats which are good open debates within the team around our structure, what we should be focusing on, cementing our goals, that sort of stuff. And from our perspective, it's clear to us that our opportunity is within Phantom to become the number one liquidity provider on the network, and we are heavily based around setting our goals to make that a reality. As for multi-chain, I think multi-chain will come after we fulfill that sort of area of our goal structure. Since coming onto the network, we had some pretty hefty goals ahead of us, and we've basically cemented a lot of those. We've hit a lot of our goals that were initially set for us around trading volume targets, things like that. And now it's really for us to get back into that building phase and find ways to be as competitive as possible as we can on the network. We're not ones to just sort of sit back and, the space is so fast moving that one day you're sitting there and then there's a new opportunity that comes through. It's an efficient type of liquidity. And you need to be thinking about how you can, either integrate that into your system to make it work well, or what are other revenue types streams that you may need to come up with. So we're effectively always looking to, point ourselves in the direction of becoming the number one supplier of liquidity on the FTM network. And multi-chain is probably a natural step once you sort of master what you're trying to do within the one network, and then you grow to your potential. Then effectively, the only way to grow after that, apart from growing the network or the network growing around you, is to then look at other opportunities. So yeah, we wouldn't rule out multi-chain, but at the moment our focus is solely around pushing ourselves to new heights within the Phantom network.
Yeah, thanks for that. And building on top of that, I mean, what would you say differentiates Equalizer from other DEXs, or for that matter, other solidly forks that the market can't stop talking about?
Yeah, there's lots of things really. I think, look, we were, if you include the most successful launch of a iteration of the Solidly model, it would have been Velodrome, which have done remarkably well, and they've proven long-term sustainability to this point, which is fantastic to see. We came into the market with an adaptation of their model. We forked their code base. We thought that they had adjusted some areas that we were very happy with. We thought that it aligned with the protection of the system, like things like whitelisting of liquidity, or whitelisting of token types, that sort of stuff. The repair of the system for bribing, which effectively was which was a bit of a failure and disaster in the initial model. And then we looked at the tokenomics level, and we basically thought that effectively the way to win is not to oversaturate the market with tokens early. You want your people to come on and have a fairly good share of the protocol, and that in turn allows people to get a much better earn on the system. So if we look at our adaptation there, we basically took, if you look at solidly today and the amount of tokens that's submitted, we have a locked amount at the moment of about, almost say 60, 70 times less. So effectively, we saw that as an opportunity to reinvigorate that tokenomics section, make sure that we had an opportunity for those people that were voting to earn a good share. And to do that, what we did was we heavily increased the fee structure. So the Solidly model came out with a low fee structure. Velodrome tweaked it with a slightly higher structure, and then we were the first ones to come out with the 0.2% volatile swap fee, and then we adjusted up the stable swap fee slightly as well to improve the revenue on that. But the biggest adjustment was we took the Solidly model, which was 0.1% fee for liquidity, which we believed was too low and was a reason why it could not house liquidity. Because effectively, if it's burning itself out and you're expecting a token to support that liquidity, but there's no earning for that token, then you have an issue. So our biggest adaptation was to increase that fee and then support those people that lock your token to support it. What we also did was we reduced heavily the amount, and we reduced the amount of time you need to lock that token by 8 times. So we have a 6-month lock, and we did that because we felt that, a 24/7 market, locking a token for 4 years is an eternity. Basically, you're never going to see that token reappear on the network. Maybe that's a model for it, but I have a strong feeling that you incentivize people to lock their token when they know it's not forever. So I think we give a much easier barrier to entry on people entering VE Equal. Also, it's made our NFT market much more liquid. So that was a big change for us, was to drop back the amount of time you need to lock your period for. And really, the big innovator, and funny, a lot of people have sort of followed this model, was we did an airdrop. So we airdropped our token to people that had an understanding on the model currently, who'd operated on Velo, who'd operated on the Solidly model up front, and any of the layer 2s on that. We incentivized those people. We gave them a free stake in the protocol so that they could get used to it, so that they could help us spread the word, but at the same time educate the community. And I think that was a really, really big change in the way we incentivized, early entrants to have a little trial of the protocol. But also, some of those people we see them still today, hanging around, very excited and assisting people with how to get involved. But effectively, yeah, they were a lot of our changes that we made, and along throughout the way, I think we're always reviewing our tokenomic structure. The structure of our decks and how we improve that. Like, as I've said many times, efficient liquidity is at the top of our list. So,
yeah, for sure. Thanks for that answer. And following up on the distribution of Equal, do you think doing an airdrop is the most equitable way to distribute your token while rewarding early participants in the ecosystem? Or is it kind of just a way to get started, I guess?
well, I think because we made everything about our airdrop, and those people that came in and started off with that airdrop were the first voters, right? So they started our governance program. They got a really good incentive to come on board and earn, and effectively that made them quite sticky and happy with the protocol. They were coming back to. We didn't just give like a really small. Okay, you get 30 cents. We gave them quite a considerable amount that earned enough to come back and definitely spend the gas each week to vote and participate. I actually think a lot of our success was built around that airdrop, and I think you'll see that since then we've had numerous people have come to us and said, "Can we airdrop your users? Create a program to work in with you to airdrop those people because your community is so strong." That in turn was a really, really good way for us to find the people out in the market that had experience with Solidly. And as I said before, I know I'm repeating myself, that was key to making sure that we had the right structure and the right community initially set up that knew what we were about, and they could help us spread the word. So, yeah, look, the airdrop was instrumental in our launch, I believe.
Yeah, thanks for that. And moving on to the next question. So, let's move on to the token Equal. So, do you mind telling us how it fits into the protocol and why you adopted the vote escrow model that Curve pioneered? And I also believe that it's a variation of the vote escrow model. So, you can touch on that if you want to.
Yeah, so Equal is our native token. It's the token we use to emit each week, and that token goes back and supports the liquidity on the protocol. So that Equal token is basically governed or decided on where it is sent each week by the VE Equal holders. So that's anyone that locks their Equal up and becomes a vote escrow Equal ERC 721 wrapped version of the token. So basically we use a financial NFT to wrap the Equal up, and you can lock it for a period determined by the contract or by yourself, which effectively interacts with the contract. And then it becomes our token for voting. Where that model is specifically used in the past was with Curve, and effectively it was an ERC20 version of that. So you effectively did this within a contract, but then it was more of a liquid token that could go back out onto the market. The difference with our model is it's an ERC 721 NFT, and that NFT effectively houses the contract. So it makes it a little bit more, gives you some advanced features by doing that, but at the same time allows you to have a system which has a little bit less, which has a liquid version of your NFT, financial NFT, that is semi-liquid and can be sent or interacted or transferred. Basically, at the moment, we have a lot of transfers that go through PaintSwap, but it also provides a beautiful amount of sort of clunkiness to the system as well, I think, which allows for people to to still interact and have a position, but they can also then move it in like chunks. It sort of is a really good way to keep people interested in the platform as well, I think, by having that locked version, which then supports the token Equal and ensures that it's not freely available on the market to be dumped against people at the moment that we have a low volume week. So effectively, I think it's a very, very that part of the model was very, very specific to Andre and his vision. And I think it in itself has a lot of merit. And we always talk about how good, and it's a bit of a perfect balance how that V NFT works.
Yeah, thanks for elaborating on that. And also, do you think essentially wrapping this lock position into an ERC 721 token allows for there to be more utilities integrated, like using it as collateral, lending it, and so on and so forth?
Yeah, definitely. So it does allow for more, and the biggest one I would say is that, like as you see on PaintSwap, it allows for us to have a .svg integration across the front of it, which is data driven and basically displays what that NFT based on the data is, and it really gives a good visual representation. So that's one huge factor. We have access to our VE escrow contract, which effectively gives us a lot of control around that piece there, so that we can, we just did a migration to V2, where we effectively kept everyone intact. They had their positions. We were able to switch our voter contract back to that and effectively keep everything intact so that no one so we basically made a complete migration to V2 and no one was affected that was in that V equal position apart from that their votes were reset and they had to vote again on the new platform. So it gave us a huge amount of flexibility by having that type of integration. And there's other integrations that the devs will tell you that are well and above what I'm actually aware of, but also it's proved to be a very, very valuable piece to our model.
Yeah. Thanks for that. So moving on, so Equalizer pivoted from the VE33 model, I guess, by taking the 3-3 out of the equation. So for those listening, let me provide some context. I mean, 3-3 was initially developed by Olympus DAO, which means taking their token Ohm would result in your position rebasing and essentially your share of the market cap remaining the same. So you're not diluted, I guess you can say. So there's also some game theory behind it, but we won't get into that. So many solidly forks have implemented this model where if you lock their token, you're not diluted and your governance power stays the same. So Blake, can you tell me why you felt like taking the rebasing out of Equalizer's model would be beneficial to the project's tokenomics and long-term success?
Yeah, 100%. I think it was a very major step for us and an area that we saw concern with. The rebase mechanism allows for people to, or basically shortens the life cycle of the protocol, and that was something that we've been very very vocal about, and also very mindful about in our structure of the system. Was that we don't want to be basically stopping people from wanting to increase their position, or also from from entering the market or entering our protocol at any point along the journey. Now, the moment, and the best example I gave it yesterday was 1 year on. You have the solidly model V2 with 60 or 70 million locked tokens, and they output 70 million tokens roughly, 70,000 tokens for the week. So if you could buy up all of those tokens, now don't forget the liquidity is low. If you could buy up all those tokens for the week, you would have 0.1%. And you'd probably pay a couple of $1 million for those tokens because you've got to try and buy them in an illiquid market. So I think the effects are very, very easy to see in that model there, how rebasing shortens the life cycle of a protocol because it stops new entrants. Effectively, the moment you protect people that start off in the program, which they're already benefiting because the people that start off in the program early, in a lot of cases, have a higher voting percentage anyway, and they a higher percentage share of the revenue, and they basically earn a lot more anyway in that initial phase, and they get a longer period to earn for because at the end of the day, our tokenomics may work for 4 years, they may work for 10 years, but they may work for a year. Who knows? But what we mainly see is that if you were to have a rebase, you definitely shorten that cycle of people being willing to enter and then lock their token, especially if it's a 4-year lock period. So the rebase in itself is it has not been proven successful in any model yet. I know Velo have heavily reduced that and seem to be ticking along quite well, and they'd be the first ones to maybe make it a year with a rebase model, and their rebase is like 30%, so it's much heavily reduced from the initial full dilution protection. But I just really think that as a lot of people have documented and done reviews on, that the rebase has proven to be a much fairer system. And I think, with the name and to play off equal a little bit there, we've gone that method of being that equal protocol and the protocol for the community and retail. So most of the solidly iterations have targeted having a protocol-based system where protocols come on, bribe, and it becomes a lot about the bribes. we've actually gone a route about trying to generate volume and fees and healthy, sustainable revenue, plus obviously the bribes come on top. We have the retail community, which are very engaged and enjoy the platform. And then that brings the protocol. So we've sort of done it in reverse. We actually found removing the rebase, but then also engaging the retail community was where we found the biggest opportunity for revamping and making some modifications to those initial models.
Yeah, thanks for that. And do you think part of the reason why Velodrome decreased their rebasing rate from 100% to 30% is, I guess, seeing how well the Equal model was doing with no rebase?
No, so Velo obviously had launched before us. They did the first modification to take the 100% rebase back to 30%, and don't quote me if that's exactly what it is, but I'm pretty sure from memory, and I haven't looked at the docs for quite some time. But they were the first ones to see a problem with the rebase system, and they basically drastically reduced it. We then were like, okay, we like that you've reduced it, but we like the idea of having no rebase because effectively, why would you try and at some point stop new entrants? Like, why would you not incentivize people to compete for the fair market? And we get a lot of people that want to keep their percentage share, right? And that probably has come from, that being the model that was initially put out with Solidly. But it's okay not to have the same amount of share in 6 months' time. Like I often say, are you upset that you don't have the same Bitcoin share in
Yeah.
6 months' time? No, you're happy to have your share of Bitcoin. You've got your piece, you've got your 1 Bitcoin, you've got your 10 Bitcoin, you've got your Ethereum, whatever that is. People are happy to not have the same percentage share in a protocol that emits. So I think it's it's a faulted way of thinking that you have to always have that same percentage. People often change their percentage ownerships of protocols, and I think it's okay not to sometimes have to keep up with that level as long as you're happy with what you're earning, you're happy with your initial investment.
Yeah, and I guess in some way, of course, the 3-3, the rebasing definitely deters later entrants, but also I feel if as long as there are entrants that come later, the earlier participants are always rewarded. It might not be in the form of a rebase, but you're still benefiting from the token that you hold being adopted and stuff. So yeah, definitely agree with the points you made there. So you also touched on Equalizer being more oriented towards generating fees from the volumes, from the volume going through the decks. But I also wanted to ask, do DAOs and protocols still play a role in Equalizer's tokenomics? Is there still a demand? Do DAOs still demand the equal token and lock it in perpetuity? Because that's, I think, what we've seen with the other solidly forks.
Yeah, definitely. There is a positioning of certain protocols that basically lock for percentages of the equal ecosystem. But I think we find a very decentralized aspect of lots of retail holders as well that want a piece of it. So I think a lot of our larger lockers are actually retail that are sitting there wanting to earn basically. And that, I sit through Discord all day, probably too much sometimes, watching, the types of people that come through and the options or the way they play the game and the strategies. And some of these people, in some cases have, and they've even said to me, have either, laid off the amount of work they're doing or given up work altogether, depending on their location and the amount that they're earning. But I think we've opened it right up to allow not only protocols to fight for an earn there, but also the retail users. And any protocol that sees sense in having a position to continue to support their liquidity is definitely acquiring those positions, and it can all be seen on our DeFi Wars page.
Yeah. Also, adding on to that, do you mind talking about the capital efficiency that these solidly forks bring to DAOs? Can you explain also how the model allows this capital efficiency to be present?
Yeah, so effectively it allows for people to incentivize their liquidity with a token A that's not their own token. So that was part of Andre's first vision, was that the token that was supplied was not theirs, because in a lot of cases people were incentivizing the liquidity with their own token. It was just being sold. In this case here, you have a use case for people to either acquire that token and then lock it and earn fees for perpetuity, but effectively also allow yourself to earn that piece of it. So you can effectively bribe your way in some ways to a position by bribing and then keeping that intensity of that bribe level up to build a position of V equal by locking it as a protocol. And I think one of the most efficient ways of the way that our system works is that you can go on there as a protocol, and we're not the first ones to allow you to bribe on a DEX, but we make it easy, right? You go on, you can easily create a bribe. There's a simple page for protocols to go on there and do it. They can add whatever token that's, in our case, whitelisted, and they can bribe with it. It could be their own token, could be FTM, could be equal. So the bribing efficiency occurs by being able to then accumulate a position, and also in some cases you find that that liquidity does not generate many fees. So it's inefficient liquidity in a lot of cases, and that allows for you to prop up your level of liquidity by bribing your token in. So that gives an increased level of capital efficiency for these protocols.
Yeah, thanks. Thanks for that. So are there any DAOs that or protocols that you're in the process of onboarding? Are there any DAOs, I guess, accumulating equal and kind of spinning up their liquidity and generating also fees from that?
Yeah, so one of the biggest ones is probably the Equal DAO. Also, I've got another one at the moment. I think they're in my DMs. They're about to start accumulating a position as well. From it's actually the Conch team. They're doing it through creating an NFT. So a lot of people have created NFTs and then basically use that to accumulate Equal. None to the level of the Equal DAO at the moment, and they've done extremely well. They've been very, very good for us in the way of done a lot of their own promoting. They're full of our core members, which have large V equal positions themselves. They're very knowledgeable on the space, and they've basically taken to utilizing our program or the model that we have to effectively accumulate a position, but also be good actors within the ecosystem, basically with a mission to continue to keep buying the asset and then using that to generate a snowball effect and keep accumulating. So, hats off to those types of DAOs that have really been beneficial for the network, and also stayed the course and been sort of the quiet achievers in the background that we often don't get enough time to mention, because they're just working away in the background, having their own council meetings, presenting ideas, getting involved, assisting in any way they can. So yeah, it's just great to see DAOs getting involved and then building sort of like a layer on top.
No, it's definitely great to see DAOs accumulating equal, driving liquidity to their pairs and generating fees also from it. It's a win-win, I guess, for everyone. And to finish off, let me ask you this. So do you think we're going to see a paradigm shift into DEXs based on the solidly model? And do you see Equalizer leading this paradigm shift?
Yeah, look, definitely on our network, and I think from our perspective, our network probably doesn't do quite as much volume as the other one, so it's hard to compare exactly. we think that we're doing, a pretty good job, and we've got some very, very big ideas in the pipe, and we're basically acting on those. We are sort of like a build and show you. We're not continuously hyping it up. Maybe not enough in some cases. We're just building in the background. We've got a very, very strong development team, and we effectively, we have a strong team in general between, people that are assisting with the marketing, community management, and then, the development of our protocols, and then just also that brains trust. And then also, we have the Equalist group, which are, very heavily slated to help and assist with ideas and, do initial testing for us. So we're very lucky to have, a very, very broad community, and then a very strong central team that effectively, manage and push us forward to basically getting to all the goals that we have. And at the moment, we're probably in that build phase at the moment, where we are really working hard to deploy on more efficient levels of liquidity. And I think that's the key to ensuring you reach your potential at the moment. As I said, the market moves very, very quickly in the way that it manages liquidity, and the market's getting a lot smarter. And effectively, I think there's a few forks or few solidly models that are doing quite well, and Velo and Tina are also doing well. So I think that we're watching them, they're watching us, I'm sure, and everyone is learning from each other as well to sharing the success that the model has presented to the networks in general.
Yeah, and I think that's all. Those are all the questions I have. And I mean, before we move on to the viewer questions, I just want to ask, why the name Equalizer?
It's like the old radios. No, look. So when we adjusted the tokenomics, we made it a very equalizing model. So effectively, at the moment, volume's down, and I always say we're elastic, right? We're an equalizing model. So at the moment, the token price is down a little bit, the market's down a little bit, the volumes are down a little bit, but that's only in basically alignment with the natural course of the protocol, right? So once volume ticks up, once alts get confidence back in that market, once you start to see capital flow out of the layer ones back into alts, then you start to see the model beef up, and it has this elastic movement and this equalizing effect across the way the system works. So that's where the name Equalizer came from. The token obviously was derived as equal, and we decided to take that equal fair distribution model to the market. We had no seed funding. We launched as a complete fair launch. We started the token price at 20 cents. And effectively let everyone, that believed in us, get a nice, equal opportunity to the program. We didn't give out any protocol NFTs. We just basically wanted a community-derived DEX that was there to support the community, that was there for the community to guide us, and to also be a huge part of what we do. And we think that we've sort of hit the nail on the head with the name for the model, which is equalizing and adjust as required. And then we move to the equal opportunity that we try to give everyone. We try to be as fair and reasonable as we can. And I think we're always going to act in the best interest of Equalizer and the community. That's sort of what has been our strong point. That's what we've built our foundation on. And that's what we'll continue to do.
Yeah, I guess the name really speaks to the ethos of the protocol. Yeah, for sure. I think we can move on to questions from the audience. I think if anyone has any questions, you can request to speak, and the host will let you on.
Come on, guys, don't be shy. Okay. If there's any questions, happy. Yep, go.
I have a question. So, obviously, thanks obviously for the presentation. And what I wanted to sort of dig a bit deeper into is the idea of, obviously these like three types of participants, right? You've got a trader, you've got a liquidity provider, and then a token holder, right? And the incentive for each of them is different, right? And what they sort of want to accomplish is slightly different. So obviously traders, they want to be able to swap, but they also want a low fee, right? If it's a high fee, there's a disincentive for them, and they're probably going to go somewhere else. Obviously, they need liquidity, right, to trade against, and that liquidity has to be provided by LPs. And obviously, the LPs have to be incentivized to provide that liquidity. They want a return on investment, right? And as you mentioned at the beginning, right, if your goal is to sort of provide revenue to VE holders, right? How do you see, like, there's many times this dissonance between like where liquidity is directed versus what is most profitable, I guess you could say, like pair-wise, if you know what I mean. How are you guys solving that?
Yeah, so I suppose the model itself is very, very well catered towards that, and I think the efficiency is very clear the moment you have a look at us compared to something like SpookySwap. The volume and fees generated are twice the efficiency level of them based on TVL. Our TVL is about a third of SpookySwap, which is obviously the largest DEX on the network, and we manage that liquidity in a much simpler and more strategic fashion, and that is basically because those VE equal holders have the opportunity to direct those emissions where the most efficient liquidity is. So at every epoch, which is once a week, they vote. And the vote, based on the percentage that the liquidity receives, effectively is where those emissions are sent on that percentage level. So the breakdown could be, say, 20% of the vote would go to FTM USDC, and that means that of the weekly emissions that are emitted, that 20% is directed directly to that. Now, the reason people are voting on that is because of the fees that were generated on that pool throughout the week, or the bribes that are given to try and direct liquidity. So you really get a model that is governed so well and so efficiently to point emissions to liquidity that is viable and providing what is required to earn those emissions, right? So you don't get liquidity that's very lazy doing nothing on the network so much, because people are just going to vote it. They're not going to simply vote for it. They'll send their vote somewhere else. So you don't bribe it, you don't get a vote. You don't, no volume comes through for that pair, the vote decreases. Volume starts to tick up for that pair, then effectively the emissions then get directed as people vote for it. So then your liquidity deepens and you start on that cycle. So, I think the model itself, when you really get into the nuts and bolts of it, is a very efficient way of managing where the liquidity should sit within the DEX.
Yeah. I mean, that is obviously assuming that LPs and V equal lockers are like two different users, because you have like a liquidity provider who has a shit ton of equal, and then they lock it. Obviously, they've got more incentive to provide or to direct emissions to whatever, wherever they're providing liquidity, I assume, right?
Yeah, definitely. There is the opportunity for those people to do that, but there would be a question to say, is that more beneficial for them when they could be then sending those votes somewhere else, earning a higher level of reward, and then either LPing on another DEX, or maybe not sending quite that same amount, or changing that liquidity structure. If it's not an efficient liquidity structure, then maybe it's not worth providing liquidity on that. So I think definitely you're probably cutting yourself short yourself as a liquidity provider if you're voting on liquidity. I'm assuming in most cases that you would definitely come out not on top. You would definitely have a cut in your earnings.
Yeah, if their goal is to obviously increase return on investment, right, it's probably better for them to sort of say, well, there's more of an incentive for me to switch to like a pair that is going to be more, that's going to give me a better ROI than just trying to sort of beat my head against the wall and get my pool to get more emissions, right? So it makes sense.
Yeah, I think that's how it works in most cases anyway.
Um, does anyone else from the audience have anything they want to ask Blake?
Means we answered everything for them, I think. So that's
Yeah.
always good. Either that or they fell asleep. So can you raise your hand if you're not asleep, just to make sure?